Hi there, my name is Patrick Kamure. Welcome to today's lesson of Public Finance and Taxation. Just to remind you on what we covered last time, we did the turnover tax, and where we talked about the turnover tax being the tax that is imposed on small and medium enterprise, whose turnover was between 1 million to 50 million. That was before 1st July 2023. After 1st July 2023, we say that it was between 1 million to 25 million. That is per annum. And the tax rate, which we saw was supposed to be 1% before 1st July 2023, and then after 1st July 2023, it was raised to 3%. Now, it was worth also mentioning that there was something called minimum tax. Now, minimum tax had been introduced by the government in the finance bill of 30th June 2020, and it was supposed to be, it became effective on 1st of July 2021. However, when it became effective, some traders, business people, rushed to the court. And when they rushed to the court, they wanted that tax being declared unconstitutional, of which case the case was heard. Immediately after the case was launched, it was suspended. It was suspended by the judge, that is Judge Odunga, and now came September 2021, it was declared unconstitutional, and so it became effective. So it is no longer effective. So as I record this, which I'm doing in October of 2023, that tax is not effective. So in this case, if you find somewhere about minimum tax, know that it's not effective for now as at October of 2023. Thank you very much. Now we continue with today's lesson, where now today we want to do the capital gain tax. So we need to ask ourselves, what is this capital gain tax? It's good to know that capital gain tax is the tax that is imposed on transfer of property. Transfer of property. In which case, when we talk of the property, as per the way it is defined by the Act, it is supposed to be 3 items: land, buildings, and unquoted shares. Unquoted shares, those are shares which are not quoted in the stock exchange market, like in this case in Kenya, Nairobi Stock Exchange Market. So if you transfer those shares, then you should be able to pay capital gain tax if you make a gain. So land, building, and unquoted shares. So I want to write that one here, and as I do that, it's also good to know that capital gain tax was charged first at the rate of 5%. That was up to 31st December 2022. Now, come 1st of January 2023, the rate was increased to 15% on capital gain, in which case we want to see how do you get the capital gain, the one that you charge the tax at those rates I have talked about, then you get the capital gain tax. So I'll write something about it, that capital gain tax is imposed on transfer of property. Property as per Income Tax Act include land, buildings, and unquoted shares. Another point is that capital gain tax is imposed on capital gain at the rate of 5% up to 31st of December 2022. From 1st of January 2023, it was raised to 15%. Another point is that capital gain tax is payable and returns filed by 20th of the following month after the transfer of property, where a person fill a form called CGT1 while filing the returns. Yeah, so what I had not mentioned earlier on is that capital gain tax is payable and returns filed by 20th of the following month after the month of the transfer of property, where a person filled a form called CGT1 while filing the returns. So now we need to ask ourselves, how do we get the capital gain? We have said that capital gain tax is charged on capital gain. So how do you get the capital gain that is chargeable, the capital gain tax? So another point, capital gain which is chargeable, capital gain tax is determined as follows. Capital gain is equals to transfer value minus adjusted costs. Where transfer value is equals to selling price minus expenses relating to selling. Adjusted costs is equals to purchase costs plus construction costs plus expenses incurred while or after purchasing. Minus capital allowance. So what we are saying is this, that to get the gain, the one that we charge tax at the rates we have talked about, either 5% or 15%, you take the transfer value of the property and you minus the adjusted cost. How do you get the transfer value? Transfer value is the selling price of the property, the amount you get when you sell the property. You minus expenses relating to selling. That when you are selling, you may incur expenses like advertising, brokerage fee. Remove them from the selling price you have collected. You get the transfer value. Then the adjusted cost of the property, you take the purchase cost. You could have purchased land. And then once you purchase land, the cost of purchase you put here, you add construction cost. You could have constructed a building on that land and that construction cost of the building. And then you add expenses incurred while and or after purchasing. While you are purchasing, you may incur title processing fees, stamp duty, and after you have purchased, somebody may come and say, this land used to be mine, and order you to move. And you take that person to court so that you defend that land. Those are the ones that you're saying after purchasing. So you add them. And then you minus capital allowance. That this building that you have constructed, it loses value with the time. That loss of value is the one that we call capital allowance. So remove it. So when you get the adjusted cost and you have the transfer value, compare them, you get the gain. That is the one that you tax at the rate of either 5% up to that year, 1st December 2022. After from 1st January 2023, the rate of 15% to get the capital gain tax. I'd like us to look at a question. This is what the question says. Shebe Abdara disposed of his property in September 2022 for 18,500,000. The property consisted of a piece of land he had bought in 2007 for 1,300,000. He had incurred legal cost of shilling 650,000 on its transfer, in addition to stamp duty of 13,000. He put up a hotel building at a cost of 9,800,000 and was completed in 2008. A local politician laid claim to the property in 2011. Sheba Abdara filed a suit against her and won, having spent a legal charges of 34,50,000 on the case. The following costs were incurred to dispose of the property: valuation costs, advertisement, commission to the buyer-seeking agents. Additional information: during the existence of the hotel business, the buildings had been allowed investment deduction amounting to 740,000. The capital gain tax rate during the year was 5%. So we are required to compute the capital gain tax, CGT, if any by Shebe Abdara on disposed property. And citing reasons, identify which of the following forms Shebe would use to file the returns in transaction in the one above. So we want to first of all to compute the capital gain tax. So first we had said to get the capital gain, you take the transfer value minus adjusted cost. So we need to get the transfer value, which you said you take the transfer value to be the selling price minus expenses incurred while selling. So we'll come here, we start with the transfer value. Transfer value, which is going to be, we take the selling price, then we ask ourselves, how much did he dispose the building? So in this case, we are told, almost in the middle of the sentence, he put up the building, was completed, a local politician laid claim. We are told that it is actually in the first paragraph. Shebe Abdal disposed the property in September 2022 for 18,500,000. So that is 18,500,000. Then we said you minus expenses relating to selling. So less expenses relating to selling. Expenses relating to selling. So which expenses did he incur when he was selling? In this case, we are told to us, before the additional information, the following costs were incurred to dispose of the property, to dispose, which we have valuation. So we have valuation. So those are the ones relating to disposing, which we have 247,000. We deduct. The other one is advertisement. Advertisement, which you have 52,000. The other one is commission. Commission to agents, which we have 1850,000. So this will give us the transfer value, which will be we take 18,500,000, we minus 247,000, we minus 52,000, and we minus 1850,000, which gives us 16,351,000. Then we just need to now get the adjusted costs. So we'll have adjusted costs. So adjusted costs are all the other costs incurred while purchasing, after purchasing minus capital allowance. So we start from the top. Shebe Abdallah disposed the property for 18,500. The property consisted of a piece of land he had bought in 2007 for 1,300,000. So we have the cost of land, which we have 1,300,000. After that, he had incurred legal costs of 650 in transfer in addition to stamp. And note that this transfer is when it was being transferred to him, yeah? Not when it's transferring to this buyer. It's when he was purchasing. So in this case, in transfer, legal costs. So we have the legal costs. These are incurred while purchasing, which we have 650. The other one we have, in addition to the stamp duty. So stamp duty, which we have 13,000. Then after that, he put up a hotel building at a cost of 9,800,000. That is now the cost of building, another adjusted cost, construction cost now, cost of building, which we have 9,800,000. Then after that, and was completed in 2008, a local politician laid claim to the property in 2011. Shebe Abdallah filed a suit against and won, having spent a legal charge of amounting to 3,450 on the case. So we have another legal cost on suit, which we have 3,450,000. The other one is the following costs were incurred to dispose the property, which we said is part of the transfer value. Additional information number 1. During the existence of the hotel building, the building had been allowed investment deduction of that. So investment deduction, we said we less. Remember, investment deduction is the same as capital allowance we earlier on had stated. So capital allowance or investment deduction or investment allowance, they mean the same. So we have 740,000. So meaning we can get the adjusted costs. Adjusted cost will be 1,300,000 plus 650,000 plus 13,000 plus 9,800,000 plus 3,450 plus 740, which we have 15,953. The last one I have added instead of deducting, so I'll repeat. 1,300 plus 650 plus 13 plus 98 plus 3,450, then minus 740, minus, the last one is minus, so 14, we have 14,473,000. Now with that one, we can get the capital gain. Capital gain, we had said you take the transfer value minus the adjusted cost. So you'll have 16,351,000 minus 14,473,000. This gives us, so it will be 16,351 minus the answer, which have 1878,000. Then CGT, that is the short form for capital gain tax as it is indicated there. It is 5%, and it is 5% because if you look at the year of selling was September 2022. It was before the 15% was effective. So of 1878,000, which gives us times 5%, which give us 93,900. Yeah, so that is how you get the capital gain tax. The other one we were supposed to indicate which form he was supposed to use to file the returns. And as we had indicated here, is CGT1. So here, that is number 1. Number 2, the form is CGT1. So that is how we deal with the capital gain and also the capital gain tax. So that marks the end of that lesson. I hope to see you in the next lesson. Thank you very much.